It's been a rough ride for the transports, with the group down nearly 10% in just the past month and coming off its longest weekly losing streak since the financial crisis. For more on what's behind the big sell-off, let's get to our own Bob Pisani at the New York Stock Exchange. Bob.
Thanks, Melissa. Transforms outperformed several months in the year until about a month ago when they began to underperform. Here's what's important. Take a look here. Down almost 10% in the last month compared to a 5% drop in the S&P 500. But there's big differences among the subsectors. First off, railroads have been great performers this year, with CSX and Norfolk Southern and Union Pacific all up double digits going into the month. But now they're selling off. They're down double digits in just the last month. And the truckers have generally underperformed, but have slipped further in the last month, with big names like Schneider, Knight-Swift, and Ryder and Werner. They're down double digits, as all the packagers like FedEx. So what exactly is going on here? Well, higher fuel costs are affecting the airlines. That's one factor. But outside that, the fundamentals for the transports have been really strong. Robust U.S. economic growth is the key here. There's also been very tight conditions in trucking supply, and there's been tight labor market conditions. So supply doesn't seem to be a big issue. The concern seems to be that demand might be slowing down. That's what Morgan Stanley thinks. Today, they downgraded the freight transportation stocks like Union Pacific, Genesee and Wyoming, and Old Dominion Freight based on concerns over slowing demand. They emphasize they don't see a recession, but some of their proprietary data points do indicate a modest slowdown in demand. Well, maybe. But the broad economy really remains very strong. And remember, no matter who wins the election, there is going to be attempts to pass an infrastructure bill. And that will certainly help transportation stocks. For the moment, let's call this a flutter that has not morphed into a full-blown panic, at least not yet. Back to you, Melissa.
All right, Bob, thanks. Bob Pisani at the New York Stock Exchange. Airlines, Karen, got a little bit of lift off of earnings.
Good pun intended.
Oh, yeah.
Yes. They did. Actually, the airlines, I think American hasn't yet reported. They'll report, I think, sometime later next week. But, yeah, good numbers from Delta, United. And oil's come in a little bit. Jet fuel, obviously, such a huge part of their business. So, and the business traveler is there and spending money.
Yeah. At some point, though, what you mentioned, oil, that's going to hurt, right? I mean, it's already hurting now.
Yeah, and listen, these guys all have pretty active hedging programs. I would say, again, a name like FedEx is more interesting to me, down 13% of the year, had results. So stock initially popped, gave it all back, and is much lower now. That's one of the largest components within the transportation industry. Those are more troubling to me. Those are the things where the warning bells are kind of screaming in silence on a lot of different names. And one of the reasons why maybe I got a little animated before is we have strategist after strategist who comes on, and everything's rosy, and everyone's going to get to their $3,200 S&P price targets sooner than later. But there's a lot of stuff going on, and all the components that make it up, other than a handful of stocks that are really troubling.
Silently screaming warning bells.
Yeah.
Sounds like a Halloween movie, right? I mean,
Garfunkel. You know what we need at this point in the show is somebody that could sort of look at charts and break it down.
Really, like a chartist, like a chart.
So you want me to go over the plasma?
No, but my favorite is Carter Worth. He'd be great if he were here.
You know
that would be nice if he could show up.
Maybe we should bring in Carter Worth. He says that the trouble in transports may be far from over, and it could spell more trouble for the markets. Look who's here, Carter Worth, a Cornerstone Macro. Carter.
Thank you for that. Yes, poof, here I am. I thought we'd actually expand a little bit. The transports, of course, is a 20-stock index, and it's price-weighted, dominated by UPS, FedEx, and the rails. The S&P 500 industrial sector, broader 60-plus stocks, dominated by Boeing and Caterpillar. But I wanted to show you the correlation is almost 95%. This is the XLI versus the Dow Jones Transportation. So I thought we'd look at the transportation average at the end, but first talk about the sector overall. So you can see quite clearly, I mean, literally the same percentage change over the past 5 years. Let's draw some lines on the XLI itself. Now, one way, surely, at the bottom, one could say that that's something of a head and shoulders bottom, and quite a move it was. A topping formation is this, a double top. So just as that was a bottoming formation, you could call it a double bottom. This is a double top. It has all the reciprocal implications. If we clear that, you've also got a very well-defined trend and a break-in trend. And this recovery, importantly, got simply right back to the underbelly of the line, which then puts our double top back in play. And of course, right there exactly, fails dramatically. Moving on. So now, and this is really the issue, This was the supposed narrative on the street. You wanted to be overweight financials and industrials because of regulatory reform, tax cuts, synchronized global growth. And guess what? On the top, industrials. On the bottom, relative performance. Look at these two circles I've got here. What this is the day before the election and then basically a month ago. All of the alpha's undone. And remember, that's not adjusted for beta or risk. So it's been nothing but a disaster, frankly, a risk-embracing endeavor simply to keep pace with the market, but with volatility. The Dow Jones Transportation Average, this is a 15-year chart. Look at these drawdowns. Now, this, of course, is the financial crisis. We dropped 61%. But this is a so-called bull market over the past 10 years. We dropped 20. We dropped 30. In 15, 16, we dropped 31. We've dropped 14. And this recent sell-off is 11. You can drop 30% and still be, quote, in a bull market. So let's pull it back to the final chart or two. This is the big drop, 61% in the financial crisis. This was the fixed 15, 16 drop. What if we simply were to do a 25? We're down already 11. Well, watch this. The chart itself, if we were to go to 25, that would leave us exactly at the trend line as we've done before. And it, quote, wouldn't even be a bear market. It would just be another 10% from here. I think industrials have got problems. The price action is poor, and the transports are effectively industrials. In fact, all of them are in the sector.
Come on over, Carter. Stephanie will bring the chair in. Thank you, Stephanie.
Thank you, Stephanie.
I don't even, I'm just over.
I don't even look your way anymore. I just decide. So is it your thesis, your belief that we are still in an uptrend even if we do see a substantial pullback? Well, so we know we're down 11%, 12% from the high. We know the Russell 2000 growth is down 13, 14, and we know certain stocks are down 30, 40%. Square, one of the best performing stocks, bar none, is down almost 40% from its peak. So it's case by case. But the issue is this, that we've had bifurcation for a while, which is industrials and financials were underperforming as more and more money was clustering into idiosyncratic growth. And now, of course, what's happening is bifurcation is hoped to be resolved by the strong continuing and the weak catching up. It's never been resolved that way. It gets resolved like this. The weak have the final puke. We're seeing that from Ford Motor to housing, and the strong roll. And we're in the process of that now. We have great earnings from Adobe and Netflix. What do? They do nothing but go down. Are we in a position where we could see the broader markets continue an uptrend without the participation of the industrials, without transports, with the lousy trading of financials?
Not really. I mean, there's not much precedent for the equity market in general to be advancing importantly with marquee investment banks and brokers basically collapsing. And you've got things like BlackRock down 38, 40%, Goldman Sachs, Morgan Stanley, the banks you see the action. Of course, that's not the setup that suggests, hey, we're about to just take off to the upside.
You know, in my childhood, when the Morgans and the Vanderbilts and the Mellons, transports were very important, and the Dow theory came. Exactly. Does the Dow theory still hold water in an environment where they're not nearly as important as they were 100 years ago?
Dow theory is a confirmation concept, right? That things have to get hauled or trucked around, and that if the goods and services, sort of the things that go clunk in the night, are not confirming, or vice versa, the industrial average, that you have a dispersion or diverse that will lead to trouble. What we really had this time was this, that only two sectors made new highs in September and August. So the thought is the market made the new high. It never did. I mean, that's an optical illusion. The fact that we made new highs in August, September in the S&P, while only two sectors could, while the New York Stock Exchange never could, while the CAC 40 never could, the DAX, basically, that's the bull trap. That's the sort of dispersion that ends up setting the trouble that we've got now.
So here to the end of the year, Carter, just roughly, I mean, what do you see in the charts? Do you think we finish higher or lower from where we are in the S&P?
I would think lower. I would think that the numbers would have to be perfect just to stay where we are. If there's any trouble in the numbers, I can only think lower.